Okay. Hello, everyone. I'm Gary Black. I'm the managing partner of the Future Fund LLC. We're a high conviction growth asset management firm here in Chicago, Illinois. Today, thanks for joining us today. Today, I'm going to talk about three things. One, we're going to talk about the case for growth stocks. As most of you know, growth got absolutely clobbered last year. It was down about 30%. Value is down about 10%. This year's actually growth has done much better. Growth's up about 12%, value is up about 6%. And we're going to talk first about why we think that's going to continue. Second, we're going to talk about the coming Fed pivot. If any of you listened to Jay Powell's press conference yesterday, you heard him really basically acknowledge disinflation for the first time. He actually used the word about 13 times. And he said, we'll probably have a couple more rate hikes, which we agree with. We'll probably have another one in March. And then I think that he'll pause, the Fed will pause and see where we are. And what you find is normally in those type of environments where the Fed is on pause, after raising rates for a while, the next step down is for rates to move down. And because inflation is going away and the economy is slowing, we expect that to happen later this year. The third thing we're going to talk about is our private placement offering. We're targeting a $5 million capital raise. We think now is an opportune time for investors to think about this, giving the case for growth stocks and given the Fed pause. We're a growth asset manager, and this is a really good time to be thinking about investing in our firm. So we're going to talk about that at the end. I'll probably talk for about 20 minutes or so, and then at the end of the presentation, we'll open it up for questions. I do want to thank Randy Gilling and friends from Silver Birch Growth Software Resellers for coordinating this call. And with that, let me get started. And you should have a marketing deck in front of you. So we believe there's a significant upside for growth stocks here. As we mentioned up front, they were crushed in 2022 as interest rates rose at the fastest pace in 40 years. There are now many indicators which we're going to walk through pointing to recession, and we believe that the Fed, in trying to navigate a soft landing, will start to pivot toward lower rates in the second half of 2023. That doesn't mean that they're going to immediately do it. It just means that in March, they'll probably raise rates another 25 basis points. They raised them in 25 basis points yesterday. We think then they're going to basically just hold still for a while and reassess. And Jay Powell, despite lots of efforts to try to get him to throw cold water on the word pause, he didn't, and instead said we're going to look at data again at the March meeting. And I think that gives the Fed plenty of room to do whatever it wants when it gets to the March meeting. We believe that equities, particularly growth stocks, have discounted the higher rates in an economic slowdown. That's why you saw growth stocks literally just get crushed last year. What you find if you go back in history is that in slower growth environments, growth stocks generally outperform value stocks. And as we look out over the next 5 years, we think growth stocks will do better than value stocks and do better than the S&P in general. Next slide. Okay. So you can see that that growth dramatically underperformed value last year. Growth was down about 30%, value was down about 10%. But as people started discounting that we could be going into recession and that the Fed would have to slow down the rate of interest rate increases, we've seen this year, and these numbers were put together a couple days ago, growth is now up 12%. Value is actually up about 6.5%. So growth continues to outperform value as we had the Fed meeting yesterday. As people started to conclude that while Chair Powell was talking kind of hawkishly, he became more dovish as the Q&A session wore on. And that's why you saw the market outperform yesterday or go up so dramatically yesterday. And you see it up, you see NASDAQ up 300 basis points today as the 10-year Treasury continues to fall pretty sharply. And this just shows what this is, I think it's labeled slide 5, what's happened over the last 2 years, let's call it. Actually, yeah, 2 years. So what you see is the 10-year has gone from about 60 basis points to today it's at about 3.4, and it continues to fall today. And then you see the 2-year, which is much more sensitive to the federal funds rate, which is the interest rate that the Fed can directly control. That's moved from about 30 basis points to over 4, but even that has started to come back in. This shows 1-year forward inflation expectations. And so you can look at, there's different surveys. University of Michigan is a consumer confidence survey. They actually ask people what they think the 1-year inflation number is going to be, and then the 10-year inflation number is going to be. And you could see that this peaked at about 6.7% back in, I think it was August of 22, and that's since come down to actually now below 5%. And this becomes really important as the Fed is thinking about what type of inflation is embedded in people's interest rate assumptions going forward. This shows the 5-year forward break-even rate. You can look at this on Bloomberg, or I know Yahoo Finance shows it. And this is probably a more appropriate number. This is looking out over 5 years, what type of inflation expectations are embedded in interest rates. And today, the number's been pretty stable now since for almost a year. It's been kind of about 2.2 to up to 2.5. And today it's back again at about 2.2. So there's definitely not a case to be made that inflation expectations are getting out of hand. And this is something that the Fed cares deeply about. So why are we convinced that the Fed's going to pivot? And I get more DMs and just pushback on this point than anything. And look, the big reason is inflation is disappearing. A lot of the inflation that we have today was caused by COVID. There were a lot of supply shortages. And if you look at different components of either CPI or the PCE deflator, which is what the Fed tends to use, the different components have been coming down. But one of the things that I think is really important is rents. This is a big part of shelter. Shelter is 40% of what we call core CPI. So if you back out food and energy, core CPI has been running about 0.3-ish per month. So let's call it 4 to 5% on an annualized basis. And if you look at, say, the last 3 months or even the last 6 months, core CPI has come down even more. This is a big component of core CPI. Again, shelter is 40% of core CPI. And rents have now, for 3 months in a row, fallen fairly sharply if you look at it on an annualized basis. Another thing that the Fed's going to look at is what we call leading indicators of recession. So there are some that are leading, some that are coincident, some that are lagging. Temporary employment is one of the first things that you see start to move going into recession. You can look back over the last 4 recessions we've had. And in each case, temporary employment started to fall before the recession. And in this situation, we're starting to see temporary employment start to fall again as we speak. Another leading indicator is just number of hours worked. And this comes from all these, a lot of this data that I'm showing comes from the St. Louis Fed. You could also see it in the Labor Department, monthly statistics that come out. But another leading indicator going back, 60 years in this chart is just the aggregate hours worked. And this, if you annualize them, you're seeing that number is now negative again. And that's a good leading indicator that we may be going back into recession. You saw that back in 08, 09. You saw it back in 0, 01. And obviously you saw it when COVID hit. This is the inversion of the yield curve. So if you look at, and there's different measures for inversion. We tend to look at the 10-year Treasury bond, less the 3-month Treasury bill. So some people look at 10-year versus 2-year, but this is a very broad measure of inversion. And no matter what measure of inversion you look at, you're seeing inversion again, very good leading indicator of recession. If you look back at 08, 09, look back at the 00 recession, look at back 90, 91 recession, and then back to 80s. The yield curve is inverted pretty much every time. There's been a couple false starts, but not many. And so we are seeing the steepest inversion that we've had now in 40 years, where, again, if you just look out 3 months and you look at the interest rate versus the 10-year Treasury, when the 10-year less the 3-month, and the 3-month is much higher than the 10-year today, and the 3-month is higher. That's called inversion. This inversion is the most severe we've seen in 40 years. And for those who are, what we call strictly monetarists and think about the money supply as being a good leading indicator of the economy, M2, which is a broad supply, includes time deposits, includes IRAs, includes money market mutual funds. M2 is now declining again. It's the biggest contraction we've seen since the Fed started posting this back in 1959. And if you go back to even 2008, 2009, we didn't see M2 start to decline, but M2 is now declining again if you look at it from a year ago. So that is worrisome as well. Okay, so let's talk about growth stocks, and there's lots of ways you can look at growth versus value. This comes from Empirical Research Associates, and what you could see is that if you look at enterprise value to sales, enterprise value to revenue, you could see where growth stocks used to trade. They used to trade about 6 to 7 times sales. Today, it's about 2 times sales. This is the lowest that growth stocks have traded since at least 1960. So that goes back 60 years. If you look at the enterprise value to sales of Empirical characterizes big growers, they look at the top, I think 75 biggest growth stocks. So it's a little bit narrow measure than Russell 1000 growth. But if you plotted Russell 1000 growth, you'd see the same type of chart where enterprise value to sales on a relative basis is much lower today than it's been for the last 60 years. And then the other thing you could look at is just price trends. And so this looks at the relative 9-month price trend and tries to rank where this is for big growers on a relative basis. Where does that rank? Again, looking back, this chart goes back 70 years. And that relative price of growth versus value going back 70 years, this is the most extreme it's been on a 9-month trailing basis. So this is back to my earlier comments that growth stock's been crushed. This is the best chart that I can find to say that growth has really been crushed relative to value. Put another way, you're buying growth stocks at a very cheap price today, given where growth has come. Now, so far this year, let's go to the next chart. You can see that as people have started to discount a Fed pivot, growth has actually done quite well in January. I think I read somewhere that for January, NASDAQ had its best year since I think it was 2001. And if you were to rank all the price trends on a 1-month holding period from best to worst, January of 2023 would rank in the top, let's call it, 5th percentile of all months on a 1-month basis. So what that tells me is that, growth has started to do better than value, and you're starting to see that across the market. And what's interesting is the highest PE growth names have actually been doing the best. And, so when you look at stocks and you see a lot of these in the ARC portfolios where they have, above 100 PEs or even infinite PEs if they have negative earnings, those stocks have tended to do the best. You see that with Bitcoin doing very well year to date. And again, when people talk about animal spirits, this is what they talk about, animal spirits being rekindled as the Fed starts to pivot, or at least people recognize the Fed's about to pivot. High PE growth stocks have done even better than what we call classic type growth stocks, which is type of stocks that Future Fund looks at. Okay, so what I'd like to do now is just talk a little bit about the offering, and I think it's a good time for the offering because of 3 things. One is we talked about is growth stocks did terrible last year and are starting to come around. 2, we do expect the Fed to pivot later this year after they pause after the March meeting. And then the 3rd thing, which we don't have a chart here, but it's on our 1-pager. If you go to our website, you'll see it. ETFs, active ETFs, have been surging over the last decade, let's call it. They've gone from about 10 billion in assets to about 300 billion, so a 30-fold increase in 2022, and that's our estimate. That's about 40% compounded per year. And the reason active ETFs are picking up so much share from mutual funds, which tend to grow at about 2 to 3% per year, is because of tax benefits. When you buy an ETF, your tax basis is the price you pay for it, not all the tax gains and losses that you inherit within a mutual fund. Two, and I think it's just as important, is the transparency. If you get on Twitter, if you get on Reddit, investors love to talk about the names in the portfolio. With an ETF, you have to see it every night, or you can see it every night, because the advisor has to basically show every night what names are in the portfolio and what has changed. And we do that. We post it every single night on our website. And then the third reason I think that active ETFs have done better than mutual funds is because the fees are very low. You don't have all these embedded fees for 12B1 and others in ETFs. So I think for those three reasons, active ETFs are going to continue to grow very rapidly. That's the business that we play in. And we'll talk a little bit more about how we're going to continue to grow our business in the ETF space. So let's go to the next page. So our philosophy is that high conviction portfolios are better than broadly diversified portfolios. Dave Kalis, my partner and co-founder of Future Fund, we actually have almost 60 years of combined experience today. We have a unique blend of what we call investment and operational expertise, and I'll take you through our backgrounds in a minute. As we talked about, because of the worries about inflation, we think there's a huge opportunity in growth stocks. Dave and I are both what I call classic growth investors. We look for names that are going to grow faster than nominal GDP, but which we feel are fairly priced. And we'll talk about that in a minute. We think you're going to continue to have a choppy market. It's not going to be straight up, even though if you look at the last 3 days, you might think that. We believe that the Fed, pivoting a lot of times, there's a lot of question whether they're going to pivot in time, and people will worry, are we going to have a soft landing? Are we going to have a hard landing? And I think if you look at the streets research, it's pretty wide open as to whether people think it's going to be a soft landing or hard landing. We actually think the Fed can navigate a soft landing because they seem to be very on top of the slowing economy and inflation turning into what we call disinflation. The ETF asset class, we think, is right for active management, both long only and hedged. And we will talk about, if you were to invest in us, a potential liquidity event. I think it could take one of two forms. One, when I found in the past, when I've tried to look for distribution partners, and Dave and I talk to distribution partners seemingly every week. We had one we had a long conversation with yesterday. They tend to want to buy us. And, that could be a liquidity event. Another liquidity event could be that we just decide that we're going to IPO the business once it's profitable. Okay. So just a little bit about the company. It's Future Fund Advisors, LLC. That is doing business. The brand name is Future Fund LLC. So sometimes people get a little confused. It's really the same company. We're going to be using the proceeds to expand the business, primarily to launch new strategies. And we're going to talk about them in a minute. But the most important new strategy is a long short offering, both an ETF and a hedge fund product. The offering size we talked about, a maximum of 5 million. We may do less than that if we feel we want to close it off earlier. We might do something less than 5 million. The offering price will be $10 a unit. So if you want to think about it in terms of number of shares, that's 500,000, and the minimum will be $10,000 as an investment. Okay, let's go to the next chart. And if we were to do distributions, right now we're not making money. We've only been in business for 1.5 years, but we assume we're going to be making money within the next year or two. Once we start making money, we will have distributions. They will be done pro rata. That's what that middle paragraph is saying. And if you want to look more at that, you can go to our operating agreement, which is on the website. And then we will terminate the offering at the earlier of a date when we've sold all the units. So all 500,000 units have been sold, or June 15th. That would be the latest that we would be able to do this offering. Okay, next. So back to how we do things. It's high conviction. we're believers that, what we call is kind of these diversified portfolios where you see kind of, it's not enhanced index, but people benchmark, and then they try to buy names close to their benchmark rates. We don't do that. We look for names we like, and then we rank them on a risk-adjusted basis and try to find out what has the best risk-adjusted upside versus downside, and that's how we position our bets. Dave and I like to have, 3-4% positions. Our biggest position today is Tesla, which has been our best performer year to date. It was probably one of our worst performers in the fourth quarter, but it's been a star performer since January 1st. And we look for long-term trends. For those who've looked through our marketing materials, we try to find mega trends that are long secular forces that act as tailwinds for our portfolio, and we're going to talk about them in a minute. We try to invest in companies that have winning strategies, winning products, and a good management team that exploit those mega trends. As we start to move into the long short space, again, we're going to talk a little bit about a long short strategy that we're trying to use the proceeds from this offering to seed. We like to look for companies that are strategic disadvantage. So when we tend to look for shorts, we tend to stay in the growth universe, same area that we're looking for longs, but we try to find the opposite. Those companies are going to be disrupted. Those are going to be disadvantaged as, companies such as Tesla come in to their business. Basically we're trying to look for uncaptured equity value. So, when we see a company and we try to do a long-term free cash flow earnings forecast, we try to value what that company is worth on a present value basis. We try to find companies that are selling at substantially less than what that value is. So we try to capture that uncaptured value. So just going through this a little bit, what we said is we look for secular change, we look for disruptive innovation. We want companies that are generally growing units and can take pricing. We're not really looking for companies, we had a big debate about Meta yesterday, that are really trying to gain value by cutting costs. Sometimes it gets to the point where companies have to cut costs because they've grown too fast, and we'll take that, but that's not really where you see most of our positions. Most of our positions are getting market share, and they're in growing markets that are growing faster than nominal GDP. If you think about the mega trends that we've talked about, we have 10 that we use as tailwinds. So social networking, it's pretty explanatory. Mobility, so people are walking around with their phones instead of PCs. E-commerce is replacing traditional bricks and mortar. Climate sustainability is about a third of the portfolio. Automation, so replacing machines, replacing labor with machines. Big data and security is a big mega trend. People living longer, so we're looking for drugs and therapies that can allow people to live longer. Fintech is just, basically looking for companies like LPL, which we own, that are exploiting the technological revolution in the finance space. Lifestyle betterment is a catch-all for, as people get more money, they want to improve their lifestyle. So if you think about Lulu or Nike, Airbnb, those are lifestyle betterment type stocks. And then the last one is just 24/7 information and entertainment. Something like Google would go into this. They're going to report tonight, and hopefully they will do what Meta did last night. Okay, so a little bit about Dave and I. We've known each other since I'd say about 2012 or so. And so let me just take my background. I started as a research analyst at Sanford Bernstein. It's a research boutique. We were bought out by AllianceBernstein in the late 90s. I was a partner there. I moved to Goldman Sachs Asset Management as one of the first outside partners. I was brought as a partner at Goldman, and I became the CIO for their global equities fundamental business. There's also an equities business that's quant driven. I had nothing to do with that. From Goldman, I was recruited to go be CEO and CIO of Janus Capital. I left in 2009 at the height of the financial crisis and started my own firm called Black Capital. It was a long short hedge fund. In 2012, Calamos Investments through Goldman Sachs came and offered to buy us, and I joined Calamos as the global co-chief investment officer with John Calamos, who is the founder. He was trying to replace his nephew who left the firm. And at the end of our 3-year contract, I think the cultures were a little bit different. I left, I joined Aegon Asset Management as the US CEO. And we restructured, one of my ideas was to restructure the business globally. There was a US CEO, a Europe CEO, and a Asia CEO. That never made much sense to me. It was like duplicate organizations, and they moved to a global structure. And I was one of the ones proposing that in 2019, and we started the Future Fund back in 2021. Dave has a similar great resume. He's been portfolio manager at Siegel Bryant, Northern Trust, Charis Capital Management. He joined me at Calamos as the head of the U.S. growth team. After I left, he went and formed Curvature Capital. And again, as I said, he joined me in 2021. Okay, next. And we have a really good board. Our board is investors and people from the business. Rich Bindler, who I've known for at least 20 years, he has a SPAC that he's started, but he was running the wealth management side of AllianceBernstein. That's how I got to know Rich. He lives here in Chicago and is a good friend. Ross Gerber, some of you know Ross. He runs a $2 billion wealth management firm out in LA, or it's actually Santa Monica, called Gerber Kawasaki. And he's very prolific on Twitter, talking about Tesla and other things. Alexandra Merce is another board member. Many of you know her. She most recently worked at Moody's, and she's very good at, I'd say, analyzing things and really trying to almost cross-examine many of us on Twitter. And she does a lot of Twitter spaces talking about the investment business. And Jeffrey Yu is our 4th board member. He's a trained physician, both in radiology and nuclear medicine. He's founded 2 healthcare technology companies, and he's very evaluated when it comes to the healthcare side. So collectively, they're our board. They're all a little different. Their personalities are all a little different, but their job is to basically act as a sounding board for Dave and I. Okay, so here's the product roadmap. We have FFND, that's the Future Fund Active ETF. That today is doing very well this year. I think we're about 5th percentile this year. We didn't have such a good last year because of Fed rates going up pretty dramatically. But in an environment like we're in, where growth stocks are doing better than value and the Fed is about to pivot, we should continue to do extremely well. As I said, we're up about 20% year to date, give or take. We also have a covered call strategy for those that own Tesla shares. We've been willing, if the account's big enough, to sell calls against them. That's something that we have to do very carefully. Obviously, we haven't been doing that the last couple of weeks because Tesla's been going straight up, and we tend not to sell calls during periods when Tesla's going to announce volumes or earnings, and that's why we haven't been selling calls. On the drawing board, which is where the $5 million of capital that we're trying to raise, something we already have approved by both the SEC and the New York Stock Exchange. We have the ticker FFLS ready to go. This is something we could launch within weeks once we get some capital to seed it. And then the Future Fund Long Short Fund is a hedge fund. That's a 1.5 and 15 type structure where you get a base fee and then you get a performance fee. We would like to launch that soon after the ETF. And then out in the future, we have 2 other products, a sustainable growth strategy and a future fund SMID growth strategy. So all these strategies are meant to work together. One on the call we had yesterday with potential distributor, they asked us, would the long short fund and the long only fund look similar on the long side? And the answer is yes. Dave and I, we feel if we're going to do research on a company and we develop conviction about it, we want to be able to put it in both the long only fund and the long short fund. Okay. So this is maybe the most important chart in the deck, but it basically shows our ramp up in assets. So by the end of the year, we hope to have about 225 million in assets. We're starting the year at about 50 million, but again, our performance has been good. And we hope to get to $1 billion in assets by 2027. And you go back to that chart where you look at Dave's and my experience. We've both raised, $1 billion in a year at former organizations we've been at. And so if we could get to $1 billion in AUM, which we think is a pretty conservative number, at an average fee of 1.15, why is it higher than today? Because long short has a higher fee, and you can see the fee numbers in that far left-hand column. If we can get to that type fee and that level of assets, this is a business that scales pretty rapidly. You can see the cost structure doesn't grow anywhere near by what the revenue side does. We could have operating profit by 2027 of $7.5 million. The average asset manager publicly traded today trades at about 10 times enterprise value to EBITDA. You put a 10 multiple on 7.5 million, that's worth 75 million. So the fund offering that we're doing, we're valuing it at $10 million today. If we can raise 5 million, that would be a post-raise valuation of 15 million. So if we can get to 75 million, which again is 7.5 million times 10, that would be a 5-fold increase in your investment. And so that's the proposition that we're laying out for people. Okay, so let me summarize it before we turn it over for questions. One, we think it's a really good opportunity today for accredited investors to join our growth path to $1 billion AUM. We're seeking up to $5 million at a post-raise valuation of 15 million. As inflation disappears and the Fed pivots, this to me is a really great time to be investing in growth stocks, and we're a growth asset manager. We will leverage that. At $1 billion in AUM, we estimate 7.5 million of EBITDA, which we think could be worth $75 million in 5 years. The firm is led by 2 investment management professionals who worked together for a decade with a combined experience of almost 60 years. Most of the capital will be used for a long-short ETF and a new hedge product, as well as to build out our distribution. And if you want more information, go to invest.thefuturefund.com. You can sign up, and we encourage you to do so. Again, the minimum investment is $10,000, and we think now is the right time to be doing this as growth stocks are about to take off. Okay, so Marilyn, let me open it up for questions and see what we have. Okay.
Okay, we do have several questions, so I will call on these people, and they have put it in the Q&A as opposed to in the raise your hand. So Randy, I am going to see if I can find you here on the list and unmute you so you can ask your question.
Yeah,
and the other people, if you'd like to ask your question live, if you can go down to the icons and choose the raise your hand icon instead. I'll call on you as we go along. So Randy, I believe you can unmute yourself at this point.
Sure. Hey Gary, thanks for the presentation. That's great. I actually put a couple in the chat under questions here, but one of them was just, I'd love to hear about one of your top, I know some of your longs, but I'd love to hear about your favorite 1 or 2 shorts as the market recovers.
Yeah, I mean, I don't want to be sharing shorts that we haven't posted, but I can just talk about some of the shorts that we had, that we talked about last year on Twitter that have worked out. And it's interesting. I was looking through this list today because a lot of them reversed pretty sharply in the first, month in January. But the names we've talked about a lot are Beyond Meat. I'm a big believer that plant-based meat it's not that it's a fad, but it's something that you try and you get a lot of trial. And that's why I think Beyond got a lot of sales a couple of years ago, and then competition came in, Impossible came in, and others. And so the stock was down 69% a year ago. Tilray's another one. They're cannabis makers. They were down 42% over the last year. Again, just to keep in perspective, NASDAQ was down 16% over last year. Bed Bath & Beyond is another one that I've talked about. I don't see a reason for Bed Bath & Beyond to exist. You can get everything that you get at Bed Bath & Beyond, which is not a great shopping experience on Amazon or Target or Walmart. That's down 80% over last year. Nicola, many of you read, I was featured in Barron's about probably a year ago, talking about how I thought the whole thing was a fraud. And again, this is where the CEO was basically found to push the vehicle, which didn't work, down a hill to, simulate that it was moving. That's down 65% over last year. Weight Watchers is another one that I've been very negative on. I've talked a lot about this. I wouldn't short it now because it doesn't have much market cap left, but with all the new weight loss drugs in place, people don't want to pay $20 a month to go to a Weight Watchers meeting. So that's down about 57%. Lordstown Motors is another one that we've talked about. That's ticker RIDE. That's down about 50%. Dave's talked about Peloton. Now, Peloton's had a huge resurgence this year. It's up about 100% in the month of January, but for last year it was down about 70-80%. Virgin Atlantic is another one. I just think the TAM is very limited. People who are going to spend $250,000 to fly out and look at the earth from a little bit further than where you could take an airplane. I just thought that that's very limited. Again, that's moved up a lot this year. That was down about 60% last year, but it's moved up. Affirm is another one. There's just so much competition in the, we'll call it deferred payment space. I just don't know why a firm can, distinguish itself. So those are names that we've talked about in the past. And again, I think it's premature for us to say what's going to be in a long short product, but some of those are still good shorts. And that's why I just went through the list. And again, you could look at names that I've posted on my Twitter account that I thought were good shorts. And, some of those are going to be shorts going forward.
Randy, anything else? You said you had a couple questions? No?
Yes.
Putting on the spot.
Would you mind walking through just the valuation of the fund, like where it's at? What just confirm what that includes the future fund as well as the new fund getting launched. Do you mind just walking through the valuation of 10 million, how you get there again?
Yeah, so today it's the covered call strategy, which has, let's call it about 40 million in assets, and the ETF, we have one ETF today, which is about 9. So, at the September 30th, 13F is about 50 million. And look, what we've tried to do with the valuation is think about, we haven't made money. We've only been in business for a year and a half. And as you know, most startups don't make money. But if you go to that one slide, the way we thought about it, I think it's slide 12. Let's see, where are we? Yeah. We're on slide 25. We think about the 7.5 million is where we could get to in 5 years. And we think about, okay, if that's worth 75 million in 5 years, what is that worth today? So you could take it, say, a 20% discount rate, because this is higher risk than, say, a Tesla would be. We use a 13.6% discount rate, and that gets you to about 30 million. So what we were trying to do is put some discount on it for the fact that it's illiquid. This is not something that you can turn around and sell tomorrow. So people will put a liquidity discount on even the 30 million present value. So I think it's worth at least 15 million. I mean, that's kind of the number Dave and I had in our head. And so, this is a market that, because growth stocks were down so much last year, there's a lot of uncertainty. And, as people think about the Fed, can they actually navigate a soft landing, or is this going to be, as Bank of America calls this morning, a hard landing? And so as we were thinking about valuation, we just said, look, we've got to make this compelling enough that people say, despite the fact that growth had a terrible year, despite the fact that we could have a hard landing, we believe in you guys. Your pedigrees are great. So put a valuation on here that's compelling enough for us to put money in today. And so we really want to launch this long short product. As Dave and I have gone out and talked to potential distribution partners, that's what people are most interested in, because there aren't that many. If you try to go into Morningstar or just look up active ETFs long short, there are probably a dozen of them out there. And both Dave and I have run long short products before. He's started his own hedge fund. I've started my own, and we're both good at it. I think, when I meet long only portfolio managers, the vast majority of them could not come up with short ideas. You got to be a little bit skeptical. You got to be willing to look at the glass as half empty. You got to be willing to challenge management. As most of you who follow me on Tesla, I'm a Tesla bull, but I'm constantly challenging management, and people who are good at shorting, that's what they do. They know what questions to ask, and they know where to, find companies that are going to be disrupted as well as the disruptors. And so I think we'd be really good at that. And so I think we're putting a valuation of 10 million on because we really want to get this long short product up and running in the next month or two to take advantage of all the crazy valuations that we see on some of these, what we'll call high momentum stocks in the first month. Because again, when I see Peloton up 100%, Affirmed up 100%, I see Coinbase up 100%, I just say, wow, that's too much of a move. And, some of you may say, well, Tesla being up, whatever it's up this year to date, 57%, maybe that's a big move too. But remember, Tesla was actually down, I think 55% in the fourth quarter. So, I just think it's a really good opportunity for long short. That's the short reason why we're, eager to raise capital today to get that product up and running.
Thanks, Randy. Let's move on to Rob Mills. Rob, you can unmute yourself. You have 2 questions.
Sure. Yeah, I was just curious, how do you differentiate the fund from ARK, I guess, in your marketing? And then on the long short, are you allowed to market that on social and Twitter and that, or do you have to be accredited to buy it, or how does that work?
So to buy into Future Fund LLC, you have to be a accredited investor. So if you get on the website, it's a very easy process. It takes 10 minutes. It'll ask you some questions, and you have to upload some documents, and you get feedback pretty quick. Like it takes about a day or two to be accredited. So to invest in the Future Fund LLC, you would have to be accredited investor under this 506C section of the SEC code. To put money into Future Fund FFLS once we launch it, no, you don't have to be accredited investor. I think the minimum will probably be similar to the Future Fund, and which on an ETF, there's no minimum per se. You could just buy, one share out on the New York Stock Exchange. So, to buy FFLS as a non-accredited investor, you could do that. And what was the other question you asked? The first one?
I was just thinking of differentiation against ARK. I was just pulling up your correlation and kind of comparing them, and it seems like the big liquid beast. And I guess if you guys get more liquid, that'll be better. But as an investor, sort of how do you get over the liquidity barrier when correlations are high?
Yeah, I mean, look at performance. Our product versus ARK's last year and this year, they were down, ARKK, they were down in the 60s last year. We were down around 30, like half of that. And I think this year, she's already up about 40%. We're up about 20. And I think, look, the big difference is just valuation. 90% of the names in our portfolio make money, they're profitable. And we tend to steer away from companies that don't make money. And look, we've had debates about names, and I'll give you an example, Shopify, which I really like, but it still barely makes money. And so because it looked expensive to us when we launched, we chose not to buy it, which was a smart move for last year, because as the Fed started raising rates, those high PE names got absolutely crushed. And I think Dave's, in my view, as we're in this year, is those names have run, and they run a lot because they're banking on a Fed pivot. So I'm not saying the market's going to go down, but I think the easy money with those high momentum names has been made. So I think the difference between ARK portfolios and ours, we both look for innovation. We both look for disruption. We both have what we'll call mega trend type factors that act as tailwinds for names. We're both concentrated, but I think the big difference is we are very sensitive to valuation, and we don't want to overpay. And so if we see a high PE name or an infinite PE name, it's going to have to really pass through a high filter to get into our portfolio. We just tend to be more, I think, skeptical of some of these high PE names. And, if Dave were on this call, he would say, I think what we do well is we can differentiate between the company and the stock. I love Shopify as a company, but as a stock, it just looked very rich to me. And so I think ARK is, I'm not going to say they don't look at the stock, because obviously they do, but they don't talk as much about valuation as we do when we think about a name. You could go through every single name in our portfolio, and we could tell you how we come up with what we think the valuation is. You could see the price, and we're trying to buy names that trade at a huge discount to what we think the right valuation is. That's the uncaptured valuation that we talk about.
Thanks, Rob.
Thank you.
Anything else? You're
I was
good?
going to ask for the LLC, I was kind of curious what kind of distribution plan you're thinking of doing. I mean, how are you going to get this in front of people? I mean, obviously you're saying hiring salespeople, but I'm just wondering how many you hire. Are you going to set them up in territories? How are you going to roll them out? What's the game plan?
Right. So for the first year, we will probably hire one full-time salesperson, and we'll be trying to get on a lot of the platforms, so the LPL platforms, Merrill Lynch, Morgan Stanley, the big brokers. The problem with those is they like to see a 3-year track record. So, and I did this when I was at Black Capital. If you have a long short product, they'll make exceptions. If you have a product that they need, that they don't have a lot of we'll call them competitors of us that do that type product, they'll let you on early, usually like after a 1.5-year track record. But what we found is it's very hard to get on those big platforms unless you've got at least a 3-year track record. And we have a 1.5 years. So that's going to be more difficult. We've been doing it through Twitter. We've been calling on high net worth families. And again, there are some people who are willing to take a chance with us because they could look at our background and say, you guys have had a really good investment track record over your histories, and you've been really good at raising assets. And, they want both those things in putting a portfolio manager onto their platform. So there is a direct calling effort that we have. But again, to your question, that's not going to move the needle in the first year. I think what we will probably wind up doing is choosing a distribution partner. And that's where I think Dave and I have been spending a lot of our time recently, just talking to potential distribution partners. And what happens is, a lot of times, in my experience, is they want to distribute your product, but then they want to buy you. And, I don't mind if they bought, say 5 or 10% and it was not dilutive to us. But the problem with a lot of these distribution guys is they want to buy all of you. And, we started this because Dave and I didn't want to work for somebody else. We wanted to build something out that we could make big. And we wanted to be as big as ARC at some point, and if not bigger. So I think that's the challenge we have, that we could choose a distribution partner, but hopefully they would just want to distribute our product and not want to buy us.
Great.
Right on. And then why sell a third of the LLC now? Or why not give some of that to a distribution partner and flow less to the public and just wait until you're kind of bigger AUM and get a better valuation from schmucks like me?
Well, we could. We just thought, because I have a big Twitter community that, does listen to and does, find me credible, we thought that going this route, the 506C offering, which is what we call the private placement route, was just going to be a better long-term strategy. If we wanted to sell the same amount of stock to a distribution partner, we could do that today, but then we have to make sure we're right, make sure we get the exact right distribution partner. And look, Dave and I both work for firms that, if you choose the wrong distribution partner, you're kind of locked into that decision. And I think our view was, let's see if we can get the capital so we can have a runway for a few years to get the products out there, and we can take our time finding the right distribution partner for us. And I think that's been a good strategy so far. The people we've met, it seems like we're getting more, because we're getting a lot of press lately. I've been, most of you who follow me know I've been on CNBC a lot, Bloomberg, Fox News, Yahoo Finance. You can get on pretty easy, but I've been getting a lot of exposure. And what tends to happen is you get more exposure, more and more people call up and they want to talk to us. So I think our view is that as we get more assets, we'll get better distribution partners. And I think we can be more choosy about who's going to use, who's going to distribute our product down the road, rather than pick somebody today when we're still 1.5 years into this, this path, this journey.
Thank you.
Thank you.
Okay, Oliver, I believe I just allowed you to speak, or did you still there?
Hello.
Yes, go ahead.
Hey Gary, big fan from the UK.
Thanks.
Follow you on Twitter. Just want to understand from your perspective, why should I invest in the Future Fund Advisors LLC over the Future Fund ETF, or even maybe the long short position?
I think it's just the opportunity is huge. And again, I go back to the math, think about ROI. If we can get to $1 billion, and you have to look back at our resumes, you can look at that chart that we showed in the deck and see the types of firms we've worked for. You can look both of us on LinkedIn. If you go to our LinkedIn profiles, you can see, where we've gone to school, top universities, top institutions. you've got to believe that we are good at raising assets. And I can tell you, I've raised $1 billion in a year. Dave has raised $1 billion in a year. So the question is, can we raise $1 billion over 5 years? And I did this once before when I started my hedge fund, which is called Black Capital. We raised a lot of assets, got the interest of Calamos, who came looking at us through Goldman Sachs, not a shabby institution. And he wanted to buy the whole company, which we wound up doing because they made they offered us an agreement where my hedge fund group, which was in New York, could get paid a percentage of the profits. Well, that worked, and then it didn't work because other people at Calamos were not on the same plan. And without getting into all the minutia, we just felt after 3 years that the cultures were just so different, and then we left. So you have to believe that we're going to be able to raise $1 billion of assets. And if you believe we're going to raise $1 billion of assets, that's $7.5 million of, we'll call it EBITDA. That's got to be worth 75 million if you look at BlackRock and Janus and Invesco and T. Rowe and all the publicly traded asset managers. You would say, okay, what kind of return on investment is that? That's about a 5-fold increase in 5 years. I don't think you can find that in buying I mean, you can if you pick the right stock, obviously, but to me that's a really compelling investment opportunity. If you figure out, okay, if they raise 5 million post raise, that's 15 million. You say 75 divided by 15, raise it to the 1/5 power. That's about a 40% compounded return. That's a huge return. So I just think the opportunity is really large. But you also have to believe, in addition to Dave and I, you have to believe there's going to be a liquidity event. And I'm just telling you, my history has been, as we went to look for distribution partners, those people wanted to buy us. That's what happened at Calamos. And look, it's easier to attract talent if you can have a liquid type stock. I think if we didn't do that, we would probably IPO ourselves once we're profitable. So that's kind of how you have to think about, how do you get my money back, and why should you invest in Future Fund LLC rather than just put money in FFND? I think they're both going to be great investments, but I think the Future Fund LLC could be a five times return in 5 years.
Okay.
That's great. Thanks, Gary.
Okay.
Very good. We have, I think, 2 questions from Chris Seitz. Chris?
Hey, Chris. You gonna-
Hi, you just answered my question, so.
Both
thank you.
of them?
Yep.
All right. Very good. Let's see. I do have 2 questions, I think, that don't have names with them, so I'll just read them to you, Gary.
Okay.
This one is, I like how you aim to pick winners. What is the goal hold period, assuming fundamentals don't change? What's the average hold for stocks in prior portfolios you've run over the long haul?
Yeah, our turnover is very low. I'd say it's about maybe 30%. So that would be a hold period of about 3 years, 1 divided by 30%. And look, we like to hold on to these. We don't want to be doing research and then 6 months later, it hits our target price and then we're out. And so Dave and I both agree on what our sell discipline is, and it's basically it hits our price target. The near-term risk that gets too high. There's other opportunities that have a higher risk reward, or the fundamentals change. And that's what we would normally call a research mistake. And look, you're always going to have some research mistakes where you do a bunch of research and things just change. And the smart thing is to get them out of the portfolio when you realize it was a research mistake. But we tend to not have that many of those. We've had a few. And what we like to do is hold on to a stock for 3 years and let it ride. And look, what happens, and take a name like Tesla, even though it was down 55% in the 4th quarter, the fundamentals really didn't change that much. Yeah, there was pricing pressure in China, which resulted in a price decline. And, some pricing pressure in the US, which resulted in a price decline. But they're going to make that up with increased volume. So estimates have come down at Tesla about 15 to 20% year to date. But, the stock was down 55% in the 4th quarter. So when we think about valuation and a price target, we really didn't change the price target on Tesla all that much as the stock went down. And what we wound up doing in early January, when they first cut price in China, we bought a bunch more. And then as it moves up, we've actually trimmed it back a little bit because it's up so much. It's up 57% year to date. But what we'd like to do is keep it around 9%. And what I would like is some answers on Investor Day to some of my key questions, like, has there been any brand impact because of all the Twitter noise? What kind of volume increase you're seeing as a result of cutting price? How big can this new mega pack opportunity be? So I've got a bunch of questions, and for now, we feel very comfortable keeping that as a large position. Our number 2 position is Google, which is about 7.5%. We love Google. It's a dirt cheap stock. It's trading at about 20 times earnings. We believe, even though this year's been rough because advertising revenue is down, across the board, it's a very different proposition than, say, Snap or others that we've seen. It's what Instagram, which we saw last night with Meta, is a great property. So is Google. Google search is essentially a monopoly, and they have a cloud business and they have a YouTube business. So we like to own names like that stay cheap, and as long as estimates are going up, we can hold a stock for until it hits our price target. So I would like to hold on to stocks forever if we could, but obviously if it works, it's going to get close pressure. The hardest thing is shorts. Shorts, when they work, that means they're going down. The exposure goes down as you win, as the stock works. And so you're constantly looking for new short positions as they work. And that's the challenge, because the stock can't go below 0. And, you think about all those shorts I mentioned before, like Nikola, Bed Bath & Beyond, Tilray, Weight Watchers, they're all trading at like $2 and $3 now. So I got to constantly be finding new names. And there, the turnover is going to be much, much higher, probably, 6 months to a year, if we're doing a good job, because the exposure keeps going down when they work. So maybe that answers your question.
Very good. We have one last question. Doesn't have a name, so I'll just ask it, and then we'll tie it up. When is the best time for Tesla to buy back the stock with the danger of a recession?
Yeah, I discount the danger of recession. I think the market discounts the danger of recession. I know Elon's talked about a potentially severe recession. So, they have $22 billion of cash. They're generating $10 to $12 billion of free cash flow this year after, even building out 2 new gigafactories, which is what I have in my model. So how much cash do you need for the recession, if there is a recession? And, if you look at third quarter GDP, it was 3.2, fourth quarter GDP was 2.9. I'm just not a believer you're going to have a deep recession, because I do believe the Fed is already on the way to pivoting, meaning the Fed Powell refused to answer the question yesterday, and he had lots of chances to answer it. And he used the word disinflation literally 13 times. And he refused to answer the question of, are you going to pause raising interest rates? He didn't throw cold water on that notion. And so to me, as long as the Fed does pull back and stops raising rates before they get to 5%, or if they get to 5%, right now they're at 4.5 to 4.75. I don't think we're going to have a steep recession. I think you'll probably have a little bit of a recession in the second half, but as long as the Fed pivots and starts bringing rates down, I think the recession is going to be short and sweet, and the labor market is still pretty tight. So I'm just not buying this whole recession thing. So back to Tesla, I would be using at least some of it, and we actually wrote a letter to the board advocating that they use 10 billion of the, let's call it 22 billion they have, over the next 3 years to buy back stock. Now, here's the challenge. Buying the stock at 105 would have been great. Buying it at 180, it gets a little bit, or 195, as the screen is telling me right now, gets to be much harder. And so, can you get a board to buy back stock, which is almost double from where it was, in a month? I don't know, but I would like to have it there so that if they were to miss on volume, or there's another bad PR event, they have it to support the stock and to show that they're confident in the value going forward. And let me just make one more comment on Tesla, because I think it's important. When Elon first bought Twitter, he was all over Twitter talking about, his political views, and there was so much noise as, they got rid of about 75% of the people. He has really taken that back. I mean, you don't hear him talking about Twitter that much. You don't hear him espousing his political views. And I think he's learned that that's not good for Tesla, and there's just too much noise. And I go back to the brand impact. While I don't think there's been that much of a long-term brand impact, I think in the short term, there could have been the risk of a brand impact if he kept talking about what he was talking about on Twitter. So I think he's learned, and I think we will not hear more of these, I'll call them conservative views that Elon has, because that was hurting the Tesla brand, because people link Elon with Tesla and they were linking Twitter with Tesla. So I think that's all good. And I think once he appoints a CEO for Twitter, we won't hear much about Twitter anymore, and that'll be good for Tesla shareholders. So I think that's why Tesla could continue to run, even though, it's had about, a huge move from the bottom, an 80% move from the bottom, and it's up almost 60% year to date. I still think it looks cheap. And when I define cheap, I think about future growth rate versus multiple. It's trading at about 40 times now, 2023 estimates, my estimates, but it's still growing at 30 to 35%. And as I said on CNBC last week, which got widely quoted, I can't find mega cap names that are growing units at 30 to 35% a year, selling at 40 times earnings. You just can't find it. Find me another one. It's not Google, it's not Apple, it's not Microsoft, it's not Nvidia. There are very few companies that can put up those type numbers. So therefore, I think they should be buying back stock, because the stock still looks pretty cheap.
Very good. That was our last question, Gary. So if you'd like to wrap up, we'll let these people get on with their day.
Okay, so I really hope people find that this opportunity is compelling. I hope, it's a $10,000 minimum. You would be doing the firm a huge favor in allowing us to get into the long short space and to really extend our growth path, accelerate our growth path. Please just look at it. Go to invest.com, invest.thefuturefund.com, and just at least look at what we're showing people, because I think it's a great opportunity for folks. If you believe A, that growth stocks are cheap, B, that the Fed's going to pivot, and C, that active ETFs are going to continue to grow because of transparency, tax benefits, and lower fees, do yourself a favor and go look, because I think the upside is at least 5 times over the next 5 years. Okay, thanks everybody for tuning in today. Good luck on investing, and hopefully growth stocks continue to work as they have this month.